In today's video, I'm going to show you a powerful combination between the market maker strategy and the Newtonian trading strategy in a quick and simple trade. The trade happened in the 4-hour time frame of the British pound versus the US dollar. In this chart, we can see that the market created a major high and then started to go down with mild volatility. After many bars, price created a major low and started to rise, but this time with much more volatility than before. Notice the difference in volatility from the downward movement and the upward movement. The candlesticks in the downward movement are very small compared to the candlesticks in the upward movement. That means there is a lot more interest behind the upward movement than there was in the downward movement. This might be a reflection of the market as a whole, or it can be the reflection of large traders attempting to tilt the market in specific points called liquidity pools. Observe that price is now going in the direction of the major high that I pointed out a few moments ago, and it's going up there with high velocity, as we can see by the greater amount of volatility. When retail traders who use breakout trading techniques see that price is moving quickly in the direction of an apparently important high or low, they will begin to position themselves accordingly. For example, as these retail traders see price moving up quickly in the direction of that major high, they will place buy-stop orders at the high in the attempt to get in the market and exploit the upward momentum. There are many retail traders that try to use this type of strategy because it's the most intuitive and the simplest one possible. However, since it's the most intuitive and the simplest one possible, the large traders can easily anticipate what these retail traders will end up doing. In other words, the large traders know where these types of retail traders will place their orders, simply because it's too predictable. Some people think that the large traders or even the brokers have the ability to actually see retail traders' orders, but that's not true. Large traders know where the orders are simply because these retail traders place their orders in the most obvious places possible. In the case we are analyzing here, it's extremely obvious that many retail breakout traders will place buy-stop orders at the major high. So given that fact, large traders will definitely take advantage of the situation. Let's advance price a little bit to see what happens. For those who understand the market maker strategy rationale, what just happened represents an important piece of information. Observe that before the market spiked the major high, it displayed a sort of organized behavior, meaning higher highs and higher lows in the candlestick level. This is usually the signature of large traders trying to purposefully bring the market up by buying large lots. The reason they would do this is to induce retail traders to think that placing buy-stop orders at the major high is indeed a good idea. The fact that many retail breakout traders will actually put buy-stop orders at that high means that there will be a cluster of buy-stop orders at that level, meaning that a demand cluster will form. If there is a demand cluster there can be a supply cluster as well. That's where large traders or the so-called market makers will be able to enter in the opposite trade of the retail breakout traders. In summary, the large traders can induce the behavior of retail traders to one specific point in the chart, and then when this behavior is met, the large traders will enter in the opposite trade. That's exactly what happened in here. As soon as price hits the major high level highlighted by the horizontal line, a lot of buy-stop orders from retail breakout traders were triggered, but on the opposite side of those trades, there were the market makers or large traders selling the market in greater amounts. That's what causes the spike in the upper tail of the candlestick that pierces the major high. This analysis allows us to anticipate what's going to happen in the market, which is that retail breakout traders will be wrong and large traders will be right. In other words, the market won't explode upwards as the retail breakout traders want it to. Instead, it will start to go down as a result from this manipulation maneuver. If you are a smart trader, you'll be able to watch this whole process occur from afar. You cannot be a large trader, and hopefully you will not behave like a retail breakout trader as well. What you need to do is to wait on the sidelines for an opportunity to ride along with the market makers. We already know that the market is going to go down, but that doesn't mean that we simply place a market order and wait. There is a method to do that. This is where the Newtonian trading strategy will be able to help you tremendously. There are many different ways of entering a trade like this, but in this case, we could simply place an Andrews pitchfork on the major alternating highs and lows of the market to give us the edges. We can watch price carefully and enter when price hits the upper line of the pitchfork and get out when the price hits the center line of the pitchfork. Remember that this will only work if you have the correct market context. You cannot simply start placing pitchforks randomly on the chart and expect them to work perfectly. So let's advance price to see what happens. Here it's clear that the alignment between the market maker strategy and the Newtonian trading strategy would allow for a perfect combination in a very simple trade. Sometimes the fractal flow strategy will also be incorporated to yield an even stronger result. As soon as price hit the pitchfork in the upper line, we could trigger the short position with a stop above the manipulation spike. As soon as the candle closed, we could collapse the stop loss to a few pips above the entry bar, since it displayed some selling pressure there. We can notice also that this trade would be in agreement with the risk management structure we look for with at least 1-to-3 risk-reward ratio and logical stop and take profit targets. The fractal flow series, which is composed by the fractal flow strategy, the market maker strategy, and the Newtonian trading strategy, are among the best trading strategies involving logical price action, market manipulation, and the Andrews pitchfork if you are a beginner or intermediate level. If you are more advanced, you can benefit from the price action trading series, where the trade logic and techniques are taken to the absolute limit of sophistication when it comes to chart reading. If you have interest in learning more about these techniques, check out my website fractalflowpro.com to see the course's details and testimonials from students. You can also send me an email at contact.fractalflow@gmail.com if you have any questions about the courses or any questions about the market in general. If you like the videos I make, please help support the channel by clicking the like button, subscribing to the channel, activating the notifications button, sharing the video with your trading community, and leaving your feedback below in the comment section. If you want to see more videos like this, take a look at the other videos I have in the channel. There are dozens of videos explaining different market scenarios and techniques like these. Thank you very much for watching, and I hope to see you in the next videos. Take care.